Well, good day, a very warm welcome to you, and thank you for joining me today. So, yesterday we had a release from the Bureau of Labor Statistics, and we see the Consumer Price Index came in at 1.3% for June. If you compound that out, that would be coming in at 16.8%. And when you consider that they've revised the CPI index itself to tamp it down over the course of the last 40 years. You can go to shadow stats and the numbers are much worse. But anyway, let's just stick to the government numbers. 1.3% compounds that over 12 months at 16.8%. News was not good. Okay, moving on. We've got the current Fed funds. We have a Fed meeting in 2 weeks, and the big talk is whether we're going to get, let's go to the next web page, whether we're going to get a 75 basis point or 100 basis point rate hike coming out of the Fed meeting in July. And that was all predicated on this really hot CPI number that came out yesterday. My argument would be that the CPI number is backward looking, and that if you take a look at all the key measures in the markets, at least, or most of the important ones, they're all pointing toward a peak that actually got hit in June. So let's go take a look at that. First off, let's look at gasoline prices. Gasoline prices had a double top. This is an end of day chart for gasoline prices. And we see on June 6th we had a peak, and then we have a secondary peak on June 10th. Remember those dates, because there's going to be a whole bunch of charts coming up that show you basically that same exact time frame pointing toward a peak in these markets at that point. Okay, so you move on to West Texas Intermediate Crude, and we come in and we've got the June 14th to June 8th to June 14th period, and then a precipitous decline since then. And then let's look at the interest rate markets. Well, first we'll take a quick look at the stock market. Stock market today, we can see this is a 10-day chart, looking at the 10-minute bar chart over the last 10 days. And we can see we opened up very, very weak. We had a big sell-off, and then we have rallied ever since. Okay, let's move on to the more interesting stuff, in my opinion, which is in the interest rate market complex. The 2-year Treasury notes, it's not coming in good, there we go. Here's a 2-year Treasuries, peaked on June 13th. Interesting. June 13th, it was peaked at 3.43%. Right now, it's trading at 3.12% on the 2-year note. Let's move to the 5-year. 5-year peaked on June 14th. And it's trading considerably lower. Interesting how it bounced off the highest trend line here. And we really haven't gone to a new high yet. So let's just tuck that back into our memory banks. Take a look at the 10-year Treasuries. Again, we've broken a trend line, and the peak came again June. Let's take a look here. June 14th, actually, showing June 15th on the. Here we are. June 14th came a peak in rates. And let's go to the 30-year. Again, peak in rates on the 30-year came in on June 16th. And then we've fallen off. So you can see the oil complex, you can see the treasury markets, the interest rate markets, all basically saying the same thing. And let's go to the 2/10 yield spread. And the yield curve right now is kind of screaming policy error. And this is an end of day chart. So if you updated it to today, we would have bounced a little bit and we would be at negative 0.157%. So we did get a bounce today, but again, we're in very, very negative territory. This is a 20-year chart, and we are at the lowest point as far as the yield curve is concerned, or at least with the end of day yesterday, at the lowest point in the last 20 years. And that includes the absolute disaster from 2006, 2007, that entire disaster that occurred. So anyway, let's move on. Gross domestic product. Where are we at in the economy? Well, gross domestic product in the first quarter came in at negative 1.6%. Not too good. Atlanta Fed currently showing negative 1.2%. Not too good. And I got to tell you, in the housing market, what we're looking at are basically housing industry, which has stopped in its tracks. If you take a look at some of these home builder comments, and this comes from Bill McBride over at the Calculated Risk newsletter, just look at some of the home builder quotes and the home builder sentiment. A lot more new home buyers are canceling because of higher interest rates and affordability issues. Price cuts are becoming fairly common. Drop in demand is cooling construction cost pressures, which is good. And you take a look at some of these Atlanta builder, or some of these builder comments, and they are showing a lot of concern. Someone turned the lights out on our sales in June. Sales have fallen off a cliff. Sales have fallen 75% of the last 2 months, and sales have slowed tremendously coming from Boise. Charlotte checks in. The recession is looking like and feeling like a big, long 5-year depression. Ooh, they sound pretty depressed. Colorado Springs checking in. Amazing how fast the market can change. Dallas, framing labor has become readily available. Suggesting housing starts slowdown is finally showing its typical signs. Haven't raised prices in 3 months. You can go down the list, and it's not pretty. Kennewick, which is over here in eastern Washington, sales have been very slow. Inventory is rising, repricing in our houses to try and find the new market. So it's consistent across the board. And the housing market, you're going to see some really ugly numbers coming in from the housing market moving forward. Reason I mention that is that looking forward, you're going to see you're not going to see any relief as far as GDP numbers are concerned. It's going to get worse from here on out. And I think the interest rate markets are telling us this. I think the oil markets are telling us this. I think the housing markets are telling us this. And I think the Fed would probably do everyone a favor by listening to the markets rather than listening to themselves. So that's just my opinion. What do I know? But I would tend to listen to the markets at this point. And I know that the argument right now is whether we should, kill off inflation with a full 100 basis point rise or a 75 basis point rise. I would argue that the horse is out of the barn. They're closing the gates on an empty barn. And at this point going forward, whether it's a 75 basis point rise or a 100 basis point rise, the question you're only doing at this point is not whether you're containing inflation, it's whether to what extent you're willing to kill off the economy. Because I think if you did nothing at this point, inflation would essentially take care of itself. But we shall see. Anyway, that's it for today. Just a quick announcement, I will be posting on a regular basis from here going forward. I've been working on some of the editing software that I've gotten and trying to provide a better product for everyone involved. So anyways, I hope you have a wonderful day, and we will talk to you soon. Bye-bye.